Thanks to our friends at The Motley Fool for sponsoring this video. Check out the link below, fool.com/The Smattering, to get access to the 10 best stocks to buy right now. Procter & Gamble and Walmart are incredible businesses, decades of success, lots of growth. You're going to go into a Walmart, there's chances are you're going to leave with a Procter & Gamble branded product. So therefore, if you're worried about the economy, if you're concerned about the stock market, these are two companies that might look like attractive dividend stocks to buy. Here's the thing. I have no interest in owning either of these two companies, especially for dividends. We've got some really good reasons why. I'm Jason Hall. This is The Smattering, and we're going to talk about that. We've got somebody else here who has no interest in owning these two stocks, Tyler Crow. You're not interested either, but we've got some alternatives too, right?
Let's be clear here. We're not saying we don't like these companies. This is going to be a valuation matters video.
There's a wonderful company, and then there's, is it worth buying right now? One of the best ways to harm your ability to grow your wealth over time is either to pay way too much for companies that don't really succeed, or to just pay a little bit too much for companies that don't really have the ability to grow their cash flow per share at a high rate. And I think that's the case with Procter & Gamble and with Walmart right now. So let's just start off talking about these businesses from a valuation perspective.
I'm going to use Dividend as a proxy here for a lot of other valuation discussions. But let's just take Walmart, for example. Right now, the dividend yield is projected at 1.63%. Not great, right? We were talking about a high interest rate environment. So 1.63 with 5% treasuries doesn't look great, but can we justify it?
You can get 4% on your cash sitting in a money market in your brokerage right now.
Exactly. So we need to justify that with upside, right? If it's only 1.6%, then obviously this thing needs to be growing enough to justify paying that little amount. If I were to go over the last 10 years of Walmart's dividend payments, they've grown their dividend payment annually by 3.4%. So much of the past decade, when we had 2% inflation, it's basically done 1 percentage point over inflation. So you combine the fact that it's been pretty sclerotic growth for a decade, and it's trading for a dividend yield of 1.6, which is historically low, or at least the lowest it's been in the past 15 years. And then you start looking at other things like price to cash flow, price to earnings, and all of a sudden the stock looks pretty expensive for what you're going to be getting in the future.
I want to illustrate this. We'll start with just price to earnings here. This goes back to 2005. And you got to remember, this is a period that was pretty good growth for the company, growing its footprint, expanding more supermarkets with its supercenters. But even back in those periods, it was consistently trading for less than 20 times earnings. At recent prices, we're talking 33 times earnings. Let's look at operating cash flow. Times operating cash flow. Again, you see historically, that is a substantial premium. And the one elephant in the room here, and you talked about, Tyler, is that interest rates are much higher. So large pools of money that are looking for stability right now and to capture some kind of yield, they're not looking at Walmart, right? They're looking at treasuries. That's really important because there's been a lot of money that's flowed to the Walmarts of the world that isn't necessarily going to be as safe in terms of the total returns that investors want to be able to generate. I don't think we need to belabor the point with Procter & Gamble. Again, this is a very mature company. It's facing some headwinds with foreign exchange with international sales. But again, this is a low growth company trading for 25 times operating cash flow, trading for 31 times free cash flow. This is a very high premium to pay. You're paying above the S&P 500 multiple for these companies, and you should not be paying an above market multiple. Great companies, but they're investments that are far more likely to underperform the market and potentially even lead to losses in the short term. But over the long term, you can do far better. Let's do this. I don't want to, people are watching this video, they're looking for ideas. They're trying to find the best way to grow their wealth. Part of that's through dividends. Let's give the people what they're looking for, Tyler. What's a dividend stock? And again, we don't have to find something high yield here, but let's talk about a stock that can generate some income, has a history of generating returns that you think right now is priced at appropriate levels that can generate the kind of returns that people might be thinking about getting with these companies.
Sure. So one I'd like to mention is A.O. Smith. They are residential water heater manufacturer. They have about 40% of the US market. It is a very resilient business. 85% of sales is you replacing your water heater when it blows. So very resilient business in North America. It doesn't have a high yield, 1.7%. That's a high yield for this company because over the past 10 years, it's grown its dividend 20% annually. That's the trade-off we're talking about here. 1.7% yield doesn't look great compared to treasuries, but if I can reasonably expect significant increases to my dividend over the next 10 years, that's a very different equation.
Its dividend in 2013 was 6 cents a share. Its most recent quarterly dividend was 30 cents per share. Growing that dividend on a regular basis is one of the ways that A.O. Smith has been such a wonderful compounder over time. Okay, so I want to go a little bit more obscure, but I think a company that is
more
really
obscure than water heaters. Here we go. Yeah, let's do this.
I can do it. The reason why this is more obscure is people know about water heaters, right? You'll see a water heater in a Home Depot. The company I want to talk about is Clearway Energy. I think Clearway Energy is really attractive right now because it's a behind-the-scenes business that's driven by really great growth tailwinds. And that's the continued deployment of more renewable energy, not just in North America, but around the world, because renewable energy from solar and wind costs continue to fall. And this is a company that sits in the right place in the value chain. Tyler, you and I've talked about with the solar panel makers and a lot of the companies that make the equipment in the industry have been terrible investments over the long term because of that race to the bottom with pricing. But companies like Clearway Energy are in the right place in the value chain. They deploy solar farms and wind farms, and then they sign long-term contracts to utilities, big companies that use a lot of electricity, buy power directly. We're talking 10, 20-year terms on these contracts, right? So they lock in these steady cash flows. They can lock in on these long-term contracts, right? So they're not necessarily super high growth at an individual level, but again, all the tailwinds that are flowing money into deploying these assets creates really strong, stable cash flow streams that allows investors to capture that yield and then above average growth of that payout. That's where you're going to make a lot of your money. And the growth of that yield over time is going to really pay off. You get stability that I think a lot of investors are looking from with these companies because of the stability of their cash flows over time. And you get a higher yield. Sometimes that can make it a little bit easier to sleep at night. They're not impervious. They're not perfect like any stock, but I think it's part of a diversified portfolio when you're looking for a little more stability. I think a company like Clearway Energy could be a good fit.